Hello, everyone. Darrell from the WealthSpire investment team here for our Markets in 2-Minute series. Today, we wanted to zero in on equity markets and particularly the relationship between market pricing and earnings. So 2022 is a perfect example of the anticipatory, forward-looking nature of markets. And that's because we had a situation where prices were declining despite the fact that earnings growth was still positive. And here in this table, we're illustrating the actual numbers behind all of that. So depending upon if you're looking at large, mid, or small cap stocks, earnings growth was anywhere between 3 and call it 7%. Market returns, on the other hand, were in the negative 20% range. So what that tells us is that returns in 2022 were driven entirely by earnings multiple compression. And that's what the change in PE figure here is trying to show us. So for equity investors, that's a number which is very closely tracked because it represents how much money you are paying for every dollar of earnings that a stock or a basket of stocks is generating. So it's a good way to sort of gauge how cheap or expensive stocks are. And circling back to the comment I made at the beginning about markets being forward-looking, in the case of last year, the combination of rising interest rates and the outlook for a potential recession in the future caused markets to kind of grow more and more concerned about future earnings growth, and prices dropped as a result. So the market was concerning itself more and more with what it was expecting to happen in the future as opposed to what was going on in real time. And as we move into 2023, that's going to be an important thing to keep in mind because we should be anticipating earnings growth to potentially turn negative. The good news, of course, is that the markets have already begun to account for that, at least to a certain extent. So a logical next question would be, what does all of this mean for the here and now? Well, for one thing, as a result of what we just talked through, valuations are looking far more favorable than they did at the beginning of last year. And while valuations have historically been a poor market timing mechanism, they have been useful in guiding us toward reasonable longer-term expectations. So with the multiple compression that took place throughout last year, we're starting to see some pockets of value opening up in certain areas of the market, particularly in small cap stocks and in international stocks. Here we're using price to cash flow instead of price to earnings, but the same general principles apply. And if you take a look at the right-hand side of each of the tables here, you can see that the current price to cash flow multiples in these two areas of the market have now moved well below their long-term medians, which is an indication of a much more favorable starting point for investors going forward. Now, there are still risks on the horizon as we enter 2023, and things could easily remain choppy for quite a while. But the setup for a multi-year time horizon has materially improved. So we would say it's still a good idea to remain disciplined and maintain broadly diversified exposure to equity markets, even despite the recent volatility. We'll, of course, continue to watch all of these trends and we'll keep everyone updated as things develop. So thanks for listening in and hope everyone has a great start to the year.